I wanted to start with just the elements of investment banking, and then I wanted to talk about changes in it that came about after the financial crisis of 2007 through 9. So, okay, the topic is investment banking. And that is a term, a 20th century term, that first became big and important, I would say, in the 1930s, but preceded that by some years. And it refers to a business of helping other businesses create securities. If someone wants to issue stock, they go to an investment banker to help them. Or if you want to issue bonds, you go to an investment banker. It can be a corporation that goes to the for-profit. It can be a non-profit corporation. It can be a government. I suppose even an individual who is incorporated can go to an investment bank. That's the investment banking business. Now, it differs, it shares something with the consulting business, because investment bankers serve often as consultants. A company will come to an investment banker with a problem, and they want to raise money by issuing new shares, for example, to solve that problem. But if it's a good investment bank, they will do more than just issue shares for them. They'll talk about their whole corporate strategy. So in that sense, an investment bank looks like a consulting firm. But that's not, because they don't do pure consulting. They're not, that makes a distinction. Maybe they're in many ways a favored consultant because they bring money, right? You can talk to a consultant who will bring you no money, and another consultant who has his hands on money somewhere, and that helps a lot. You know, the advice and the money together helps a lot. So investment bankers are different from traders because they usually they deal with creating something, about making a corporation or a government, making it work, and enabling them to do something that they want to do, and then being realistic about it and coming up with the money to do it. And so that's how investment banking differs from consulting, and it differs from commercial banking in that a pure investment bank does not accept deposits. You can't go to your investment bank and say, I'd like to open a savings account. They don't do it. Okay. I'm talking about a pure investment bank. But let me just give you something about this business. I'm going to come in a moment to pointing out that most investment banking businesses are not pure investment banks. But let's talk about what a pure investment bank does. It does underwriting of securities. That means, suppose you're a company and you want to issue shares. You need someone to go to bat for you, someone who knows the kind of people who might buy your shares and can vouch for you. So in some sense, it's a reputation thing. The investment bank has contacts among people who make big investments, and they manage the issuance of your new shares, and that's called an underwriting. If it's the first time you've issued shares, it's called an IPO, or initial public offering. So you're a private company. It's just you and a few friends own the company, but now you want to go public. You would generally go to an investment bank and talk to them about how to do it. And the investment bank would would solve that problem for you by doing an underwriting. So traditionally, there's two kinds of underwriting. There's also something called a seasoned offering. And that means for a company that has already gone public and it already has shares traded so that the shares are seasoned, but you want to issue more shares. So you can go to an investment bank to do that as well. Okay. There's two kinds of deals. There's a bought deal. And then there's a best efforts. With a bought deal, the investment bank buys your shares. They go in and say, we know that we can get market for your shares. We will buy them ourselves and resell them on the market. A best efforts offering is one where the investment bank doesn't buy it and doesn't promise anything. They say, we'll make our best efforts to place this offering. Okay? So those are the basic things that they do. The methods that they use are regulated by the Securities and Exchange Commission in order to make the SEC in the United States and regulated similarly in other countries. So that's the basic investment banking business. We talk about moral hazard. I think that an important part of what investment banks do is solve a moral hazard problem. And that problem is that companies who issue shares don't have a reputation. And so what do I care? I'll issue shares right before we're going to go bankrupt, okay? We know inside that we're going to go bankrupt. So, hey, let's just see if we can milk this company before the public knows it, okay? And issue shares. That's a moral hazard. And the investment bank is in business to prevent that moral hazard. They do the due diligence. They check you out. And then after that, people are more trusting of the... So I think investment banking is built around trust. It's establishing trust. I wanted to talk about what has happened in the crisis. There's so much to say about this topic, but maybe I should talk first about the first crisis. In 1933, the U.S. Congress passed the Glass-Steagall Act. Which forced investment banks and which prevented investment banks from doing commercial banking or commercial banks from doing investment banking. It split them in two. And it said, you have to decide, are you a commercial bank or are you an investment bank? The Glass-Steagall Act was the act that created the FDIC, the Federal Deposit Insurance Corporation, the first national, successful national deposit insurance act in the world. And part of it makes sense. If you're going to insure the commercial banks, you better watch what they're doing and prevent them from doing dangerous business. So the dangerous business was investment banking, and they forced companies to decide. So J.P. Morgan, which was doing both investment banking and commercial banking, in 1933, had to decide, what is it, investment banking or commercial banking? So they picked commercial banking, and that means they fired all of their investment bankers. So these guys regrouped, and they formed an investment bank called Morgan Stanley. Stanley was a Yale graduate, and Morgan was, I think, not J.P. Morgan, it was his grandson. This was, Morgan died around 1911. And so those were two separate, one, J.P. Morgan, commercial bank, Morgan Stanley, investment bank. But since then, we've repealed the Glass-Steagall Act, and that occurred with the Graham-Leach Act of, what was that, 1999? Well, Graham Leach repealed Glass-Steagall, and now these businesses generally do the same business, both commercial and that was Graham Leach was 1999. Okay. Since then, you might, as you recall, we've had a financial crisis. And in that financial crisis, Glass-Steagall got brought up again because it seemed that the crisis was related to a number of shenanigans that firms were undertaking. And the government had to bail out commercial banks. We've talked about this, and it's very controversial. So the question is, did these banks get in trouble because we repealed Glass-Steagall? A lot of people came on saying that. These banks were doing all kinds of screwy things that were dangerous, and we are insuring them, so it can't be. So a lot of people said we have to go back. There was some inherent wisdom in Glass-Steagall that we've lost, and this was debated. Now, incidentally, I didn't mention this. Glass-Steagall was somehow confined to the United States. Outside of the United States, there was, I don't know if there was any country, but as far as I know, U.S. was the only one that did it. So outside of the United States, they had what was called universal banking. And these banks outside of the U.S. were doing both investment banking and commercial banking. They sailed right through the whole century without being divided up. And so the reason why we got Graham Leach was that we started to, people started to say, we're at a competitive disadvantage. We Americans are at a competitive disadvantage to Europe because we can't do both. And they have more freedom than we. And so eventually, in 1999, we said they could do both. So that U.S. also became a universal banking country. But then problems arose, and the problems were Paul Volcker, who was chairman of the Federal Reserve Board in the late 70s, early 80s, proposed something called the Volcker Rule. And the Volcker Rule was not a full return to investment to Glass-Steagall, but it would, and this is now in Dodd-Frank Act. It's section 619. It doesn't say Volcker Rule there, but that's what it is. And it prohibits proprietary trading at commercial banks. And it also says that commercial banks can't own hedge funds or private equity. So that was the Volcker Rule that was put in. There was also another rule added, which is analogous to the Dodd-Frank Act. Also, and this is in the Dodd-Frank Act of 2010. There was a senator. Her name was Blanche Lincoln, a Democrat from Arkansas, who proposed the Lincoln Rule, unrelated to Abraham Lincoln, as far as I know. And the Lincoln Rule was, or Lincoln Amendment, and that is section 716 of Dodd-Frank. It says that it doesn't prohibit banks dealing in credit in swaps. But it said swap dealers barred access to the Fed, to Fed window, discount window. And so effectively, it prevents banks from dealing in swaps anymore. As a result of this, Goldman Sachs has got to shut down, or it appears that Goldman Sachs, the Volcker rule says banks have until October 2011 to comply. So it means that Goldman Sachs has to shut down. Well, Goldman Sachs had to become a commercial bank too, so it's no longer a pure. It's a official commercial bank now, and because of the Volcker rule, it appears that it has to shut down its proprietary trading, which was a huge part of its profits. And Goldman Sachs will never be the same again, apparently. But it's not clear what will happen. It depends all on how Dodd-Frank is enforced. I think that people in the investment banking industry are going to try to claim that some of the activity that was done by their proprietary traders, that is, people who were trading the markets on the. I understand, true investment banking shouldn't involve the investment banker buying and selling securities trying to make a profit. That's not underwriting of securities, that's proprietary trading. Volcker rule says that you pretty much can't do it anymore, unless you were a pure investment bank. But if you're a commercial bank, you can't do it anymore, and they're kind of forced to become a commercial bank. But they're going to try to steer around these rules, and I think that maybe they can. They'll redefine something that looks something like proprietary trading, and then continue to do what they're doing. We'll have to see. These things are long and arduous. One thing that strikes me about finance is that it's so rules-based. There are so many laws. There are so many lawyers that you can never, nobody can grasp the magnitude of the regulations that these people live under. And, you see these landmark bills, but none of us understand them because the real content of them is involved in hundreds of pages of legal documents that never cease to amaze me with their complexity. Let me say something about shadow banking, which is relevant here. The term shadow banking, I think of that as coming from a term that I first heard from people at PIMCO just within the last 5 years or so, but it refers to, maybe it goes back further than that, it refers to a new kind of semi-banking system that, what are shadow banks? These are companies that are acting like commercial banks, but they're technically not, so they're not regulated as commercial banks. And in many cases, the investment banks were shadow banks. And I'll give you an example of Lehman Brothers, which was a pure investment bank. It's now bankrupt, it's gone. It was a pure investment bank, so it wasn't regulated as a commercial bank. And this was before the Volcker rule, before Dodd-Frank. And they went bankrupt in 2008. And it was the worst moment in the financial crisis. Why did they go bankrupt? Well, there's a reading I have on your reading list by Professor Gary Gorton here at Yale, who argues that Lehman, like many other investment banks, was financing a lot of proprietary investments by issuing repos or by dealing in repos. What is a repo? That's short for repurchase agreement. And a the banking crisis that we saw in 2008 was substantially a run on the repo. So here's what happened, according to Gorton and others who agree with him. Investment banks like Lehman Brothers were not regulated like commercial banks. And as long as they didn't accept deposits, they didn't have to be regulated as commercial banks. So they could do what they wanted. They were considered underwriters, so fine, do whatever you want. Well, not quite, but they weren't heavily regulated the way commercial banks were. And what Lehman Brothers started to do is to make heavy investments in subprime securities and other securities by effectively borrowing through the repo market. And what is the repo market? It's a market in which a company effectively borrows money by effectively selling some securities it owns with an agreement to repurchase the security at a later date. They're short-term loans, in fact, collateralized by some security that they own. What it was is almost the same as a deposit. They were short-term loans that someone could withdraw at any time. The someone wouldn't be some, mother and father with their small savings account. It would be some bigger, probably institutional investor. But these were acting like banks, like commercial banks, because there could be a run on these banks the same way there's a run on a commercial bank. If anyone starts fearing that Lehman Brothers is going to fail, they all want to take their money out, which means they don't renew their repos. And so Lehman Brothers failed when the housing market declined, the value of its subprime securities declined. People who were lending it money through repos got wind of this, and they stopped wanting to do it. So it was like a run on Lehman Brothers, and Lehman Brothers could not be saved if it weren't for a bailout. And the government had already bailed out Bear Stearns, and it had helped Merrill Lynch, which was failing as well. And they decided not to bail everybody out, so they let Lehman Brothers fail. So now the reaction to that is that we can't let shadow banking go unregulated, and Dodd-Frank is part of that reaction. So now investment banking is substantially altered by these laws, and it still, of course, is a very important business. The United States has traditionally been the most important country in investment banking, but it continues that Europe and Asia are also important, very important participants in investment banking. Growing, I think. The financial crisis has put something of a damper on the business for a while, but I think it seems to be coming back. The latest news is that investment banking business is starting to look more stable and prosperous.